Posting their worst day in more than 5 years. The NASDAQ closing 6% lower today. Joining us now, Dan Ives, Wedbush Securities Global Head of Technology Research. Dan, it looked pretty ugly out there today. You're usually bullish on the potential for technology, but this picture is complicated, not just by the dollar impact of the tariffs, but by what happens to brand America around the globe, where even this software has to be sold, no?
Yeah, I mean, look, it's essentially an economic Armageddon. You know, if these tariffs stayed in place, and I think the reality is talking in front of a microphone in the 202 area code is a lot different than the reality of moving the supply chain. And I think it speaks to our point that when you look at China-exposed names, from NVIDIA to Apple to any of the semi names, I mean, this is as nervous as I've seen investors going back to, COVID, March 2020.
So what do investors need to listen for on these earnings calls? What are the fundamental numbers to watch, perhaps when it comes to margins getting squeezed, to understand what the real dynamics are going to be throughout the rest of 25 and where you can continue to get a valuation premium?
So I think there's three things I think you have to look at. One, I mean, Navarro talked on negotiations. You have to assume that these tariffs don't hold in their current form. If they hold in their current form, then essentially you have 15 to 20% demand destruction across the board in terms of costs that are actually going to have to come through. And to that point, I don't think a lot of companies even give guidance on their 1Q conference calls, given what we've seen in terms of the head-scratching tariffs. The thing that you really have to focus on in terms of like what demand destruction looks like in terms of when it comes to AI revolution, data center build out, inventory, and then of course you start looking at consumer focus, names like Apple in terms of what that means for iPhones. The reality is if you want an iPhone made in the US and you want that for $3,500, we should make it in the US. If you want it for $1,000, you keep it in China. So I think these are all the issues that investors are trying to sort of game out.
Recent news in the stock market has set the stage for a potential economic upheaval. Word on the street is that President Trump's tariffs could spell disaster for the U.S. tech sector, sending shockwaves through major players like Apple and Nvidia. Let's delve deeper into this unfolding saga. Welcome back, everyone, to Investocracy.
So in light of that, I'll just use Apple as an example. There's just this automatic assumption that any kind of price increase tied to 54% tariffs on goods imported that have been made in China, iPhones perhaps included in that, is going to be pushed out to consumers. Is that actually going to be the case, especially if you look at an Apple that has pretty robust margins and maybe is going to absorb some of that cost?
Yeah, Mark, if it was a smaller tariff, that's something that maybe that they can absorb. But these are numbers, I mean, that are I view as absurd, and I think many view it across tech. So there's only whoever's going to pay it, it's the consumer. And that's the reality. You can talk about tariffs all you want. Consumers are going to pay it on iPhones. They're going to pay it on electronics. They're going to pay it across the board. And that's really what you're seeing in terms of self. I think right now, tech stocks, you look at a name like Apple, essentially baking in numbers cuts, 12, 15%, and margin erosion that could be more. So our view in terms of how we're navigating this, very similar financial crisis days, COVID 2020, is that you have to look on the other side, assuming some sort of normalized earnings into 25 and even 2026. And those are the names, whether it's Microsoft, Apple, and some others. That's how you navigate from, looking at the scenarios in terms of how these play out.
It's interesting because we did get exemptions on semiconductors in the midst of these tariff announcements. But another area of the market that was very defensive today and held up relatively well were defense contractors themselves. Now, I realize not necessarily the case for the Palantirs of the world, but in general, when you're talking about some of these types of companies that are exposed to government revenues, that maybe are a little more domestically focused in terms of the stacks they've built out, is that a place to be investing right now?
Yeah, I mean, and I think Palantir and others, but if you look at Lockheed and some of the primary, no doubt, those are ones that held up, I think, a lot better in terms of defensive. But I think devil's in the details, because the reality is when you look at the implementations, you look what comes from foreign perspective, you're talking 40, 50%. A lot of these implementations from a hardware perspective and others. So that's why our view is like what, and to your point, John, is like what are the second, third derivatives? What's the ripple effect? What the demand destruction is? I think investors, if you look here, these stocks are baking in recession into these stocks. If you think it's anything better, and you're basically saying some sort of game of high-stakes poker, and there will be negotiation, then these are the names that you ultimately buy. But look, it continues to be, if these tariffs stay, we've said in tech, it's an economic Armageddon.
All right.
In the midst of the chaos, one can't help but make light of the stock market's unpredictable nature. As they say, investing in stocks is like playing a piano to a cat. It might sound like a terrible idea, but hey, someone's amused. Dan Ives, the senior equities analyst at Wedbush Securities, has sounded the alarm about the detrimental impact of Trump's tariffs on tech companies heavily reliant on China for their operations. Trump's 10% tariff decree, coupled with specific tariffs on Chinese imports, has pushed tech giants to a crossroads, contemplating the future of their business models. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
Well, joining us now to talk more about the possible economic fallout from the tariffs is Torsten Slok, chief economist at Apollo Global Management. Torsten, it's good to have you on. We just heard it from Dan Ives. He's talking about the idea that if these tariffs stay in place at these current levels, it's Armageddon in technology. How are you gaming this out right now, especially given the fact that, look at like Vietnam, for example, 46% tariff. I realize there's a transshipment argument to be made when it comes to something like China, but these are just huge numbers.
Yeah, because, Morgan, that's absolutely right. A very important part of this discussion is that 40% of the revenue in the S&P 500 companies comes from abroad. And for the tech companies, the Magnificent Seven, it's 50%. So there is a significant dependency, especially among the Magnificent Seven, on the rest of the world. So given that tariffs are having a bigger impact on the rest of the world, at least in GDP terms, than on the US, that does mean that there is some trouble, especially for the tech stocks as a result of tariffs.
Has the risk of recession risen here in the last 24 hours?
Absolutely, because we already came into yesterday with negative corporate sentiment. CapEx planning among corporates in Fed surveys was showing that corporates were planning to do less CapEx over the next 6 months. For consumers, we saw sentiment decline, both for households making more than $100,000 and households making less than $100,000. And consumers also are more worried about their jobs. And consumers are also saying that business conditions in the next 12 months will be worse than what they have been at any point in the last 40 years. So the conclusion is that consumer sentiment has been weakening, corporate sentiment has been weakening, and now over the next several quarters, the most important thing that Navarro just said is that there is no negotiation. And if that is true, then we should plan that this will have negative implications for earnings for the S&P 500, again, especially for the Magnificent Seven over the next several quarters. So this does indeed raise the likelihood of a recession, especially combined with now more than a 10% sell-off in the S&P 500.
Well, Torsten, you just mentioned it. Let's hear it. Here's what Trump administration senior counselor Peter Navarro said about whether the tariffs are negotiable.
Let me make this very clear. This is not a negotiation. This is not that. This is a national emergency.
So with that in mind, Torsten, I'm looking ahead to the jobs report.
Don't miss out.
And here's how I'm thinking of it. And I'm not an economist, so I'm looking for your insights and correction here. If it's a really good report, well, then maybe that helps folks imagine that the consumer can hold out for a while if there's some negotiation, despite what Navarro just said. If it's a really bad report, well, maybe that makes people think, well, the Fed has to cut because of that part of the mandate. But if it's just a mediocre to slightly bad report, might that be the worst scenario tomorrow for the market?
Well, I think this is a very important debate, John, because let's say that this number is good, meaning 150,000 jobs created in the month of March. Then the market will say, well, this is stale information because we just learned a few days ago about a significant increase coming in tariffs and therefore a significant negative hit to corporate earnings because of the required structural change for the U.S. economy. If, on the other hand, we do get a really bad number, then that tells us that, well, the numbers were bad even before the news of this week. So in that sense, it's a very asymmetric setup when it comes to the employment report for tomorrow. We've already already seen, including today from the Challenger Gray and Christmas, that there's more layoffs, especially in the federal government. So the fear, of course, you can have is that slowly over the next several weeks and months, we will begin to see the unemployment rate begin to creep higher. And combining that with the decline in the stock market, negative sentiment for consumers, negative sentiment for corporates, and also the negative impact of tariffs on earnings, it does look like the picture here for the economy is like there's more downside risk going forward.
Ives predicts a grim scenario where companies like Apple may raise prices to offset production costs, potentially leading to a significant drop in consumer demand by 15% to 20%. This could usher in an era of demand destruction unseen since the COVID March of 2020. The stark reality is that consumers will ultimately shoulder the burden of these tariffs, with prices likely soaring on popular gadgets and electronics. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
All of that said, there may be some negotiating going on. The president posting on Truth Social he had a good call with Vietnam's leaders that turned some of the exposed stocks like Nike, the other footwear makers, around. And moments ago, the EU Trade Commissioner tweeting he had frank talks with the Commerce Secretary and the U.S. Trade Rep, saying U.S. tariffs are damaging and unjustified, and the trade relationships between the U.S. and EU need a fresh approach. So what's the strategy here, and how does the public feel about it? Let's bring in Derek Thompson. He's a writer at The Atlantic and co-author of the new book, Abundance. All right, Derek, have at it. I mean, where do we start? Do we say, well, the stock market reaction is one thing, but we're trying to do something different for this country. We're trying to make housing affordable again. And I don't know. Where would you point our attention?
To be totally honest, Kelly, I've been listening the last 10 minutes of this show. I cannot believe what I'm listening to. I heard your last guest say, if the economy shrinks, that's good. If the stock market goes down, that's good. If the housing market crashes, that's good. If there's a trade war, that's good. When did the capital class get taken over by degrowther protectionists seeking 19th century autarky?
Okay, but Derek, let me just jump in for a second, because if there's one refrain we've heard from millennials over the past several years, it's that the dream is gone. They can't afford a house. Groceries are too expensive.
It's literally the first chapter of Abundance.
It's apparently the first chapter of your book. So
Yeah.
Aren't you a little surprised to hear the globalists, the pro-stock market types who are supposed to be at fault for all of this, now reading out of your book and saying we're bringing prices back down?
They're crashing the economy. That's very, very different than making housing affordable. If you want affordable housing, you need a job. If you crash the economy, you're going to have unemployment. And whenever unemployment hits an economy, as we just saw in 2008 and we saw before in the 1990s, who loses their jobs first? It's last one in, first one out. It's young people. So if your job or if your plan is to crash the economy in the short term for the purpose of helping young people afford a house, you have got it totally backward. Young people need jobs, they need money, and then they need a plan to make housing affordable, right? Donald Trump could have come into office and said, what I want to do is to make the construction of housing affordable. That means the inputs to housing. Instead, he slaps a 25% tariff on Canada, which we import our lumber from, and a 25% tariff on Mexico that we get drywall gypsum from, thus immediately raising two of the most important inputs for housing by 25%. This is a strategy to make housing less affordable at the same time that you make it harder for young people to keep a job because the stock market's puking. This is not the way to go about abundance. This is scarcity meeting scarcity. This is Trump saying we don't have enough housing, so we need fewer immigrants, or we don't have enough manufacturing in the U.S., so we need less trade.
With the impending storm brewing in the tech sector, it's crucial for investors to tread carefully. However, amidst the chaos lies opportunity. As we navigate through these turbulent times, consider the potential growth and resilience of the stocks in question. Remember, in the world of stocks, every downturn presents a chance for an upturn. Keep your eyes peeled, stay informed, and who knows, you might just ride the wave to success. But what do you think? Share your thoughts down below. Finally, if you would like to know what companies like NVIDIA have been up to these past few days, go ahead and click on the next video on your screen. See you there.